Hello and welcome to Echelon Decodes. We're glad you could make it here this evening. We're talking to Lee Buchheit. Thank you for joining us. You're joining us from New York State. It's 7 o'clock in the morning. Appreciate you taking the time out this early. Um, to start with, Lee, you've been dealing with sovereign debt restructuring for a good 40 years, I think, right? Can you tell us about the role that you have been playing in sovereign debt restructuring? How many such instances of debt restructuring you've been part of, and on what side of the table did you sit on? Did you sit on the side of the table of the creditors or of the borrowers, the sovereigns in this case?
Okay. Good morning, good evening. Wonderful to be with you, folks. I got involved in this business at the very beginning of the Latin American debt crisis. That was in the summer of 1982, when Mexico announced that it needed to impose a moratorium on the payment of its external debt. The circumstances of that crisis were that many countries had borrowed from commercial banks, typically US dollars, and the pricing of those loans was based on a floating interest rate, the London Interbank Offered Rate, LIBOR. And at the end of the 1970s, the then chairman of the Federal Reserve, Paul Volcker, in an effort to deal with inflation in the United States, raised US interest rates very high, to the point that by 1981, LIBOR got to be 22% per annum, which rendered the debt stocks of these countries wholly unsustainable. Mexico was the first. My former law firm was lucky enough to represent Mexico in that. I was a junior lawyer on the team and decided almost from the very beginning that this was a type of practice that I would like to pursue. As 1982 and 1983 went on, some 24 countries had to go into the same process. My firm, because it had been working with Mexico, which was very much the flagship of the sovereign debt restructure of that era, my firm wound up representing a number of those countries, and I was privileged to work on their debt restructurings. In the 1990s, the commercial banks left the process and were replaced by bondholders. And in this century, sovereign debt crises, to the extent that they've involved commercial lenders, have almost all been bond restructurings. That is, we can discuss it, a very different process, but I have been almost always on the sovereign side of the table. It is, in my view, the more interesting side of the table, because it isn't just finance, and frankly, the legal aspect is relatively small. There is an enormous political aspect to it, both internationally and domestically in the debtor country, and in all candor, a great deal of theater in the process. So that's a very quick biographical survey.
Since you retired, Lee, which was about a year or two ago, have you still continued to be involved in sovereign debt restructuring in any way? Are you involved right now, if that's something you can disclose?
Yes, I have. I no longer act as a legal advisor to the debtor countries. I think I have been described as a strategic advisor, but I agreed to help the Guaido administration in Venezuela. I have been working this last year very intensively on the debt restructuring for Belize. Belize is a Caribbean country that has restructured its debt 4 times in the last 15 years. And it has a transaction in the market right now. In addition, I consult with official sector actors, and I'll answer the phone, whoever calls. So a number of other countries who may be facing debt difficulties post-COVID. So we're entering a rather fragile period in the sovereign debt business.
Yeah. Is it your experience, or have you seen that the incidence of countries getting into trouble has accelerated markedly since COVID?
It comes and goes. There never has been a period in the last 40 years when the good Lord did not provide work for his sovereign debt restructurers. But only sometimes have we had the kind of contagious sovereign debt crises that we saw in the 1980s, for example, with the Latin American debt crisis. And even that was a misnomer. That crisis afflicted countries as far afield as the Philippines and Poland. We saw in the late 90s in East Asia a number of countries, Thailand, South Korea, having debt difficulties. It will depend principally on 2 things. First, how munificent the market is. That is the market prepared to finance these countries when they want it or need it? And second, of course, interest rates. We have come through the last 10 years an extraordinary period in international finance in which there has been a confluence of enormous liquidity in the private capital markets as a result of the quantitative easing programs of the major central banks, and a period of near zero interest rates, also dictated by the central banks. And so in some sense, this has been nirvana for emerging market sovereign borrowers. Now, if either or both of those factors were to recede, then we would be facing debt difficulties, perhaps in a number of countries. And of course, the COVID crisis has placed enormous and wholly unexpected burdens on these countries. They're spending money to try to deal with the COVID crisis. There have been measures put in place by the official sector players to try to cushion the blow of that, but those measures are running out at the end of this year. And so we will have to see what the post-COVID landscape looks like in terms of emerging market sovereign debt difficulties.
Sure. I mean, as I said at the outset, this conversation in large part is likely to look like a sovereign debt restructuring 101. What does it mean? What do we do? Right? At the outset, let me we've been interchangeably using, at least we in Sri Lanka have been using several terms in discussing sovereign debt restructuring. And those terms are, as the title of this presentation or webinar suggests, restructure is one word we use in terms of sovereign debt. We have come across this term, reprofile the debt. We have also heard about haircuts, and then clipping coupons and clipping the principal payments. So several terms here: restructure, reprofile, clipping coupons and clipping the principal, and also haircuts. Are these interchangeable terms in the sovereign debt restructuring business?
No, each carries its own meaning. The sovereign
Okay.
debt restructuring business, like all activities, has its own jargon. Restructuring is the generic term.
Sure.
So restructuring connotes some change to the financial terms of a debt instrument. Typically, that will inflict a net present value loss on the holder of that instrument. There is a charming aspect to this business, which is that it's not all that complicated. Open up the toolbox of a sovereign debt restructurer, and there are only three tools. There are three things you can do.
Sure.
You can reduce the principal of the debt, the capital portion of the debt, and that is referred to in the jargon as a haircut. So you owe me $100. The debt restructuring means that you agree that we'll reduce that to $80. Haircut, $20 haircut. The second thing you can do is adjust the interest rate. Now, on bonds, the interest rate is referred to as a coupon, because in the old days, there literally were little perforated pieces of paper attached to every bond, and you tore it off, and that represented your claim to an interest payment. You can reduce the interest rate, the coupon, on the bond. And the third is you can extend the maturity of the instrument. If the problem is that the instrument matures tomorrow and you don't have the money to pay it, fine, perhaps the debt restructuring takes the form of an extension of the maturity by 3 years, in the hopes that in 3 years you will have the money to pay it. Or you can mix and match all three of those things. You ask about reprofiling.
Yeah.
By the way, there's a good deal of euphemism in this business, and reprofiling is one of them. The genus is restructuring.
Sure.
One species is reprofiling. Reprofiling connotes a transaction in which maturities are extended, but there is no principal haircut and typically not even an adjustment to coupon. The term was first used in 2003 by Uruguay. Uruguay had 18 bonds in the international capital markets at that point. They did not want to restructure them in a savage way, because they felt that they simply needed a breathing space in order to recover their financial footing. And so what they said to the creditors was, let's move the maturity date of each of those 18 bonds out by 5 years. But we'll leave the interest rates, the coupon rates where they are, and we won't haircut them. And it worked. It worked. Uruguay has never again had to restructure its debt. The term took on greater significance a few years ago when the IMF changed its policies. The traditional policy of the IMF was binary. If the IMF concluded that you had an unsustainable debt stock and you had lost market access, the IMF would open a program for you on the assumption that you were going to restructure that debt stock. By restructure it, I mean do something like a principal haircut or a coupon modification. Or if the IMF concluded that your debt was sustainable, they would not ask you to do that. But there were a large number of countries that fell in between those two bright lines. And the question was what to do with those countries. You see, if the fund did not require the country to restructure its debt, then money lent by the IMF and the other official sector actors to the country might just bleed out to pay commercial creditors in full and on time. And if it turned out that the country's debt was unsustainable, those creditors will have escaped and been replaced by official sector, aka taxpayer-funded lenders. So the change in policy was to have a third category applicable to countries as to which the fund staff could neither assert with confidence that the debt was sustainable, nor could they say it's unsustainable, and that was to reprofile the debt. It meant that you moved the maturity date of the commercial debt outside of the window of the IMF program into which the IMF is lending. That solved the problem of having the money simply bleed out to pay commercial creditors in full. And in effect, it's a holding pattern, and you wait to see whether circumstances will render the debt stock sustainable or perhaps unsustainable. And if the latter, the commercial creditors are still exposed to the country because they have been reprofiled, pushed out.
Sure, right. So, so we don't know where Sri Lanka would land, whether our debt is sustainable, is it unsustainable, or do we fall anywhere in between? Lee is certainly not expressing an opinion here, but let's explore something somewhat more basically at the outset. And it's about how countries get into this stage in the first place. Now, one can argue that a country cannot necessarily, or one can suggest that how could a country get into an unsustainable, how can a country accumulate an unsustainable amount of debt? Typically, if you are a business or an individual and you want to borrow from a bank, they'd want to see your cash flows, projected cash flows. They'd possibly want some collateral in return. Is it generally to suggest, is it true that, or is it so that out there in the global financial markets, somehow these principles that we are used to for companies and individuals are somewhat suspended?
Yes, I expect they are. Look, in this century, no sovereign borrows money with the expectation that they will repay the money, if by repay you mean divert current resources from the budget in order to settle the liability. A sovereign in this century borrows in the sure and certain hope that when that bond, when that bond or loan matures, the sovereign will be able to go back into the market and borrow again to repay the maturing debt. And when that new bond matures, it'll do it again and again and again in perpetuity. It is fatuous to believe that the politicians in these countries are squirreling away the money to repay their existing indebtedness on the maturity date. They are all assuming it can be refinanced, to use the jargon. It can be paid back with the proceeds of a new borrowing when it happens. Now, that injects enormous fragility into the system. There are a variety of things that can happen that may prevent a country from being able to refinance its debt. The markets may turn arthritic and decide that they no longer wish to take the risk of lending to emerging market sovereigns. Interest rates can go up. The country's economy can suffer some kind of shock. A particular affliction of countries that are primary, whose economy is based on a primary commodity export like oil or bauxite or copper. Something can go wrong elsewhere in the world. And all of a sudden, the investor community wakes up and says, my gosh, if that could happen to Mexico, if that could happen to Argentina, perhaps it could happen to Ruritania. Let's make up a country. And that puts the debtor countries in a very delicate position. It means that you have maturing bonds that you cannot refinance from commercial sources. So what are your options? Your options, frankly, are find an official sector lender who's prepared to give you the money if you can. That was Greece's dilemma in 2010. But of course, they were a member of the European Union, and so the European Union was prepared to lend them the money to repay their maturing bonds for a little while. You can run down your reserves, and this is probably what every country does. You can hope that the circumstances that have denied you market access will pass, as long as you continue to show the market that you're paying your maturing debt. This often is a ruinous policy. Or the third option is you restructure your debt. You go to your existing creditors and say, folks, no one is prepared to lend us the money at a tolerable interest rate that would allow us to repay what we owe you. We don't have the reserves to continue to do this for more than a few weeks or a few months. And therefore, I'm afraid we're going to have to ask you to give us some form of debt relief. And we discussed what they are: principal haircut, coupon adjustment, maturity extension, probably some combination. And when you reach that point, then you're in the debt restructuring business.
You talked about, three options, right? Principal haircut, maturity extension, coupon adjustment. And we also talk about sustainable debt, unsustainable debt, reprofiling. Do these three approaches fit the projected direction of debt, sustainable, unsustainable, reprofiling, or do you always look for a mix? How do you negotiate this? How do you essentially figure out which mix to use for which situation when your debt sustainability isn't so clear in the first place?
Yeah, it is always a bespoke process. It's going to differ depending on the nature of the debt stock, how much of it is bilateral, government to government, how much of it is commercial. If it's commercial, is it in the form of bonds or loans? What does the maturity profile look like? What are the causes of the difficulty? Probably in the garden variety case, the cause of a country's financial distress will be chronic fiscal mismanagement, probably. But there are certainly cases in which the cause of the distress is a wholly external factor. An earthquake, a hurricane, a tsunami, a pandemic, for which the country is blameless, but nonetheless is now facing a debt crisis. And the reaction of creditors will differ, of course, depending on their perception of the underlying cause. If the creditors perceive the underlying cause to be chronic fiscal mismanagement, then quite understandably, they won't want to give debt relief to the country unless the the mismanagement is addressed. And this is very often where the IMF comes into the picture. The IMF will typically prescribe or recommend changes to fiscal policies in order to put the country on a sounder footing. And commercial creditors often, not always, but often, will say we want the debtor country to have the tutelage and monitoring of the IMF so that our debt relief is simply a bridge to a healthier Ruritania down the road.
Sure. You referred to official sources. Can we define official sources very quickly?
Yes, they come in two forms. One are the multilateral lenders. Your introductory remarks mentioned this. Sure. These will be the international financial institutions, the so-called Bretton Woods institutions, the International Monetary Fund, the World Bank, and then the regional development banks, Asian Development Bank, African Development Bank, and so forth. Sure. In addition, there is government-to-government lending. So you borrow money from China or France or Germany or the United States. Very often, those loans are extended by the creditor countries in order to support exports of goods or services from their own country. So sure. If you want to buy a steam turbine from Siemens Electric in Germany, the German export credit agency may extend the credit that will permit that to happen. So those are the two. In debt restructuring terms, by convention, multilateral money is not restructured. The theory being that those institutions are in the business of lending money into distressed situations. The very moment that every right-thinking creditor is trying to get out, those institutions lend money into it. Bilateral debt, however, government-to-government debt, is perfectly restructurable and has been since 1956 for the OECD countries, restructured under the auspices of something called the Paris Club, an informal group of, I think, 20 or 21 countries now that restructure their debt to emerging market sovereign borrowers jointly so that there isn't a competition among them as to the terms on which the debt will be restructured.
Okay, so just to go through Sri Lanka's outstanding debt, I mean, we've got those official creditors. We have ADB, we have International Development Assistance, which is World Bank lending, and several other sources. We've also got the bilateral sources. So when a country, into that mix, we also have Import-Export Bank credit, a lot of it from China, but from many other countries too. Obviously, the international sovereign bonds, which form around 30% of Sri Lanka's outstanding foreign debt, and various short-term financing facilities. When we discuss restructuring, what of all this debt gets restructured? Is there any possibility whatsoever to talk to the official sources and at least request that they consider reprofiling or delaying cash flows on their outstandings in any way? Is there precedence of that at all? And of all these other varieties of debt, which ones actually get restructured?
Okay, the multilateral debt, IMF, World Bank, ADB, that sort of thing, is normally not restructured. If those institutions have large exposures in the country, It is cosmetic, but what they typically will do is open a new program, disbursements under which are sufficient to repay what's owed under the old program. So we don't call it restructuring, but it is a species of refinancing. The bilateral debt, government to government, and the commercial debt is restructurable. And one of, and you ask, is that done without haircuts or sometimes coupon adjustments? Yes, it often is. As a matter of fact, the bilateral creditors have a strong preference for reprofiling, that is, maturity extensions. And really the only instance in which you've seen significant departures from that policy has been in that period that began in the mid-1990s and is still actually going on today, in which the so-called highly indebted poor country, HIPC, initiative was in place. This was a group of, I think, 33 of the poorest countries. And for those countries, the official sector creditors wrote off massive amounts of their claims. But that was hived off. And if you go to the Paris Club today and ask for a principal haircut, and you are what the World Bank classifies as a middle-income country, you will not find a warm reception typically in the Paris Club. There are exceptions. Classic, perhaps most visible, being Iraq in 2004, after Saddam Hussein was asked to leave. The new Iraq government went to the Paris Club. It was a middle-income country sitting on the third largest oil reserves in the world, and it got a reduction, a haircut of 80% of the Saddam era debt stock. But let's not kid ourselves. The geopolitical circumstances of Iraq at that moment were pretty special.
Sure. You did touch upon the role the IMF may be called upon to play. Is it possible to do a debt restructure without the IMF as one of the parties around the table?
Yes. Yes, it is possible. Belize is doing it right now. It does not have an IMF program. There are countries, there are regions in which the initials I, M, and F make people break out in hives. Now, part of that is history, but to bring the IMF into the process has many advantages for the debtor country. It will get a lot of free advice, sometimes a bit more than it may want. It will get some money. But to my eyes, the critical thing that the IMF brings to the process is that, let's suppose we're dealing with commercial creditors in the form of bondholders. As a group, there may be thousands of them. As a group, they have neither the resources nor the inclination to do the kind of study of the country's economy and what adjustment measures may be necessary for it to recover its financial footing. And so when the country goes to those bondholders and says, we want whatever we want, a 40% principal haircut, the bondholders have no institutionalized mechanism for vouchsafing whether that is indeed what the country needs. As a creditor, you always have the lurking suspicion that it's what the local politicians want, not necessarily what they need. But if the IMF is involved, you see, and let me state this as a general proposition. At base, every sovereign debt restructuring comes down to one simple burden-sharing judgment. How much of the adjustment of the country's economy is to be borne by the citizens of the country in the form of fiscal adjustment, higher taxes, lower public sector workforce, stripping off subsidies, et cetera, et cetera. How much is to be borne by the citizens in the form of fiscal adjustment, and how much by the creditors in the form of debt relief? And there's almost a dollar for dollar trade-off. Get an extra dollar of debt relief, it's $1 less of fiscal adjustment that you as a local politician will have to impose upon your citizenry, and vice versa. So who is to make that judgment? Surely not the debtor country, because politicians will, of course, favor debt relief over fiscal adjustment, because the latter tends to have consequences in the next election. It cannot be the creditors, because they have the opposite prejudice. The only institution we have on the planet that purports to have both the technical expertise to make that judgment and the political legitimacy to do so is the International Monetary Fund. Technical capacity because they have extraordinarily talented economists who have been doing this for the last 50 years and therefore are expert in making those judgments. And political legitimacy because most countries of the world belong to the organization. So it isn't that the Ruritanian politicians have to say to their citizens, oh, this group of foreigners are coming in and telling us to raise your taxes. They at least have the cover of saying an organization to which Ruritania belongs is coming in and offering these prescriptions. It's a little bit of cosmetics, but often found useful. And by the IMF program, implicitly, rarely explicitly, implicitly, the IMF is saying to the bondholders, let's take our example, that the debt relief Ruritania is seeking from you is both necessary to achieve sustainability and this is crucial, proportional to the contribution that the Ruritanian authorities are offering through their fiscal adjustment. And that is the crucial thing that the commercial creditors will look for. Those are the benefits of having the IMF in. The downside is that they will prescribe or may prescribe fiscal adjustments that are politically unpopular in the debtor country. And that can cause some political problems in some countries. And the IMF will be the first to admit this, in the past, they have occasionally gotten this mix wrong. It is not a science.
Sure. So it would be, or everything taken into consideration, it would be highly unusual if the IMF were not involved in a debt restructuring conversation. Sure. Who else besides the sovereign and let's assume the IMF, who else are the actors that would sit around the table to discuss debt restructuring?
Okay. This will depend on the geopolitical significance of the debtor country. Take a country with enormous geopolitical significance. Take Mexico. A 2,000-mile border with the United States means that Mexico is a matter of acute concern to the United States and always has been. Take Russia in the early or the mid-1990s. these are countries with great geopolitical significance, and therefore their partners will be interested in what's going on. Let's take something more recent, Greece.
Okay.
In 2010. So Greece, a member of the European Monetary Union, found itself shut off from the markets, could not refinance its maturing bonds starting in the fall of 2009, and faced the prospect, perhaps, of having to leave European Monetary Union. It would be a first. It would be a crack in the Eurozone that the prospect of which was unsettling to many of the European grandees of the day. And so Greece relied upon its geopolitical leverage in that context to get support from its official sector sponsors, both bilateral and multilateral. So it will depend. Take a country without a lot of geopolitical leverage, you will receive a degree of support from the IMF and maybe from your regional development bank, but otherwise you're given a pat on the back and told to go into your commercial debt negotiations and your Paris Club negotiations and do the best you can.
But is it typical to also have, say, advisors, lawyers, people like yourselves around the table? Who are these actors? Who are these other crucial actors?
Okay. Yeah. Typically, the country will be encouraged by the IMF to hire both legal and financial advisors. And they will have a role in the overall transaction. The extent of that role is very much up to the country. In some instances, the country will wish its advisors to be the principal spokespeople in conversations with creditors. In other countries, the officials themselves will want to do it, and the advisors will be kept in a wholly advisory role. So that can differ remarkably. On the other side of the table, in the 1980s and 90s, when commercial banks were the creditors, they quickly formed what they called bank advisory committees. The 12 or 14 largest lenders to the country would form a committee, and that committee would purport to represent the broader banking community. They would negotiate the terms of the restructuring, and then the committee would use its influence with the banking community to try to get them to go along with it. In the bond era, sometimes, not always, sometimes bondholders will form their own representative committees. It can be as few as 3, which was the case in Belize's pending restructuring. It can be much larger committee, and that committee will undertake to negotiate a deal with the creditor or the debtor country. When the deal is announced, the committee will say, we support it. We encourage all the rest of you to support it. And that's how it's done. And those committees will typically have their own legal advisors and sometimes their own financial advisors. So that is the dramatis personae. Let's take a modern negotiating room. You would expect to see creditor representatives of the investors sitting over there with bookended by legal advisors and financial advisors, and you would expect to see on the debtor side of the table something similar.
Sure. And collective action clauses that are found in sovereign bond agreements are something that we would certainly like to discuss. And I suppose the formation of committees are governed by covenants in the bond agreements?
Occasionally, but frankly, in a minority of cases.
Sure.
Collective action clauses are provisions in bonds that say that if a supermajority, typically 75% of the holders of that bond by value, agree to the terms of a restructuring, that decision binds any dissenting minority. This is how corporate insolvency statutes work, like Chapter 11 in this country. You get a supermajority, and very often 2/3 of the creditors to agree, and they bind the entire class of creditors. Those clauses had been used in English law bonds since the late 19th century, but not in New York law bonds. When Argentina defaulted on its debt in 2000, the very end of 2001, it had north of $80 billion of bond indebtedness, and that those bonds did not contain these clauses. What it meant was there was no institutionalized or contractual method for forcing individual bondholders to go along with a deal. Stated differently, there was a risk that so-called holdout creditors who, for whatever reason, said, I'm not going to accept the deal, could decline it and pursue their legal remedies. And that's, of course, exactly what happened against Argentina for the next 15 years. The response to that was to promote the use of collective action clauses in New York law and English law, emerging market sovereign bonds, and they have now become nearly ubiquitous. And they have improved over time. The latest iteration was in 2015, when a new version of a collective action clause was promulgated by the International Capital Markets Association and has now significantly caught on.
Talk to us about the jurisdictions under which these international sovereign bonds are typically issued. You referred to New York law and English law. Can you tell us the history of this? How do bonds get issued in these jurisdictions?
Yeah. The English law and New York law, two common law jurisdictions, probably account for 90% of the international, what you call international sovereign bonds that are issued by emerging market sovereigns. The reason is that the investor community is familiar with the law in those jurisdictions. The law has evolved over time to try to strike a balance of neutrality between the interests of debtors and creditors. Both jurisdictions covet their reputation as being neutral fora in which the judiciary will not be giving an advantage, say, to the home team creditor. And so simply it makes the sale of the bonds in their initial offering that much easier. And because they're common law jurisdictions, there is an enormous precedent for how disputes are resolved, and legal advisors can tell their clients, both on the debtor side and the creditor side, with a great deal of confidence, that this is how this provision in the contract would be interpreted, for example. something that other legal regimes might not be able to do because it's left up to the individual judge. So probably 90% of them of international sovereign bonds for emerging market countries are issued under and choose the law of New York or England for this purpose.
Sri Lanka, like possibly many other emerging market sovereigns, have several series of debt instruments that it's issued. It also has commercial credit of other types. When a country does get into a restructuring conversations, you talked about the several parameters that you can play around with. When you're around a table discussing this, do you discuss in terms of, let's assume, Ruritania? Does Ruritania then go and suggest, okay, these are the parameters, or let's assume there's one conversation and they decide collectively, these are the parameters we're going to change, and this will apply to all debt that is being restructured, that is not from an official source, essentially. How does that happen? How do you go about that?
Okay. And this is one of the important threshold issues that a sovereign would have to face. First thing to understand is the creditor's logic. What a creditor wants above everything else is to talk its way out of a debt restructuring altogether. If they can say, extract your debt relief from some other type of creditor, get it from your banks, get it from your bilateral creditors, but don't try to extract it from me. That's the ideal. But if you can't talk your way out of a debt restructuring, and if, for example, bond indebtedness is a significant portion of the debt stock, there's no way to achieve debt relief without touching it, then your objective as a creditor is to try to get the universe of other creditors participating in the debt restructuring as wide as possible. Why? Because in the end, it's a zero-sum game. The IMF will say, Ruritania, this is the quantum of debt relief you need to extract. From whom you extract it, and on what terms and how you do it is up to you. If you shrink the universe of creditors from whom you're asking for debt relief, by definition, it means that the poor devils who are giving the debt relief have got to accept more pain than they would if the universe were larger and you could spread it out. So that's the first bit of creditor psychology. Go to a creditor, go to a bilateral creditor, go to a bondholder, go to a bank, and say, we need debt relief from you. The first thing they're going to say is, are you getting it from your other creditors? Because the broader you can extend it, the less we will have to give. Second bit of psychology is a creditor will know that it has to give debt relief. What it doesn't want to see is a circumstance in which it gives debt relief that is disproportionately larger than other creditors, because that is an embarrassment. It makes that creditor look as though it didn't protect its interests. It will have shareholders and investors that will say you're not performing your fiduciary duty. So there is a strong inclination to try to achieve parity of treatment among creditors. And indeed, if you go to the Paris Club, the bilateral creditors, to negotiate a deal, and they give you debt relief, it will come together with an invariable requirement that you must extract comparable debt relief from all of your other creditors other than the multilaterals. So your non-Paris Club bilateral creditors and your commercial creditors, the debtor country will be under an injunction that it must impose comparable terms on those other creditors.
You talked about an amount of relief that has to be extracted. What does this amount look like in practice? Is it a cash flow that you're looking at? Is it a yield at the end of the period that you would want the creditors to have? What is this number? What is this amount of extraction?
Again, this is going to depend on the individual country. The IMF economists can come in and will come in sometimes and say to a country, you're simply carrying a debt stock, a gross debt stock, beyond your reasonable capacity to service. And by reasonable capacity, I mean, in one sense, every country could repay its debt if it were prepared to take extraordinary measures. I remember being involved in situations where creditors would say, why do you have a debt problem? Simply sell Patagonia to the Chileans, sell the Acropolis to BlackRock, this sort of thing. The judgment, and this is what I was referring to earlier, the judgment that the IMF economists have got to make is what are plausible fiscal adjustment measures, measures that would stop short of producing a revolution in the country politically, and stop short of actually damaging the country's economy permanently. And so they will assess that. Sometimes the fund will say, no, it isn't the gross size of your debt stock that is the problem. It is the maturity profile. You have an Himalayan spike coming up in the next 2 years. There is no way that you're going to be able to repay that unless you have complete market access. And therefore, the objective is to push that out, iron it out to a sustainable debt profile. So this will be a bespoke judgment depending on the circumstances of the country.
So everybody listening to us out there, you can put your questions onto the chat. You may already see some questions. If somehow you put a question and you can't see it there, I suggest you go back and put it. And I'll pick something up that's relevant to this stage of the conversation, Lee. How are committees for bonds formed? Is it by election or any other process? Is it common to have common CAC clauses in sovereign bonds?
The answer to the last question is yes.
Yes.
Collective action clauses of one kind or another are now to be found in most emerging market sovereign bonds. The committee issue is a particularly sensitive one. Belize, in the market with a transaction now, invited last spring the formation of a committee, simply because it is more efficient sometimes to negotiate with a committee than it is to try to deal with the universe of bondholders where there isn't a natural interlocutor on the other side of the table. They're not elected. They will sometimes appoint themselves. Theoretically, in the old days, with the bank advisory committees, the committee was formed at the invitation of the debtor country, but that was largely a fiction. They formed themselves and then informed the debtor country, we are your creditors committee. And that is what one would normally expect in a modern bond restructuring. There is a possibility that there are fractures in the creditor universe which cause them to form multiple committees. Ecuador faced this last year, where it had two committees. One committee sued Ecuador. The other committee supported the deal. And that can be a particularly tricky situation. These committees, the bondholders will tell you that they are altogether a good thing. I am not wholly convinced of that. There have been many sovereign debt restructurings done efficiently and fairly without the use of a committee, as long as the bondholder, as long as the sovereign debtor is prepared to consult with its creditor universe to get a sense of their perception of the situation and what an appropriate level of debt relief is needed. Occasionally, countries will spurn committees and try to drive home a debt restructuring where there hasn't been an effort to persuade the creditor community that the debt relief being requested is proportional to what is needed. And that can sometimes end badly.
If for instance, Mauritania wishes to restructure its debt,
yeah,
it's talking to the IMF maybe. How does it go about taking the next few steps? Are the creditors, or is it transparent who owns your debt to Mauritania? How does it find out who owns your debt?
Yeah, it is often not very transparent. The largest creditors will typically be identifiable, and they will probably identify themselves. The threshold issue, let's take Mauritania with bilateral debt, Paris Club debt, and commercial debt. A threshold issue is, where do you start? Do we go to Paris and negotiate a deal with our bilateral creditors? But remember, that deal will come with this principle of comparable treatment. So whatever the net present value effect of that deal is on bilateral creditors, we will be under an injunction to extract that same net present value from our commercial creditors. Or do we do it the other way around? Do we go, and let me give two examples. 2004, post-Saddam Iraq, the new government of Iraq knew that it had considerable support from some members of the Paris Club. After all, the United States and the United Kingdom and a coalition of other countries literally had boots on the ground in Iraq. It therefore elected to go to the Paris Club first in the hope and expectation that it would get a very favorable deal, parentheses, it did, close parentheses, and then be able to take that deal to its commercial creditors and non-Paris Club bilateral creditors under the banner of comparable treatment and say, look, folks, this is the most we can do for you. Contrast that with Ecuador in 2000. Ecuador went first to its bondholders, got a 40% haircut from its bondholders, and then went to Paris to say to its bilateral creditors, surely you will match the generosity of the bondholders in the debt relief they provided, only to be told by the Paris Club, oh no, you got your debt relief from your bondholders, and you can expect only a reprofiling from us, and a rather mild one at that. So that's a critical threshold issue. What is the sequence that you will follow? And remember, as I said earlier, the Paris Club does not like to give principal haircuts to middle-income countries. It will do it, but only under great pressure. And if the debtor believes it needs to reduce the size of its debt stock, meaning principal haircuts, and it leaves Paris with nothing more than a maturity extension, very difficult at that point to tell your commercial creditors, oh, now you guys have got to swallow a principal haircut, even though your colleagues on the bilateral side are not willing to do it. Again, go back to one of those two fundamental insights into creditor logic. You as a creditor don't want to give debt relief that is disproportionate to what your fellow creditors are giving.
Assume Mauritania, besides the bilateral and of course the commercial debt, also has commercial borrowings from China and India. This is a reality the world over. These countries are not members of the Paris Club. This can potentially complicate things. How would you suggest then Mauritania approach that? You know, this is a three-dimensional negotiation.
Yes, you're exactly right, but it is changing, I hope. Last November, the G20 announced something that they called the Common Framework. This would be a process open to the poorest countries, the 73 poorest countries. But for the first time, it said that G20 countries, including China and India, would renegotiate their debts to common framework countries jointly together with the old Paris Club. So in a sense, it was Paris Club plus China, India, and South Africa. And there are three countries that are in the process of negotiating those agreements. This was viewed, I think rightly, as a very significant step, because for the last 15 years or so, as China has become the largest bilateral creditor on the planet, it was not, as you point out, a full member of the Paris Club. It observes at the Paris Club, but is not a member. And therefore, you had a world in which there might be a Paris Club restructuring. Then there would have to be a bilateral non-Paris Club restructuring, and then a commercial restructuring. And the tension was that if you did your Paris Club first, theoretically, you have promised the Paris Club countries that you would extract equivalent, comparable net present value relief from your non-Paris Club bilaterals, and you can see the tensions that would cause. I hope that the common framework portends an integration of China and India and some of the other large non-Paris Club bilateral creditors into the process, so that is coordinated better than it has been. But you're quite right to point it out. It is a weakness of the system and has been for the last 20 years.
There's a question here, and this possibly brings in the fourth dimension to potentially Mauritania's case. And that is Mauritanian development bonds or Sri Lankan development bonds are an instrument issued in US dollars, but issued under Sri Lankan law. Mm-hmm. They are mainly owned by domestic banks. Can they be kept out of the restructuring process?
Yes and no. We haven't talked about this element. We've talked about multilateral, bilateral, commercial creditors, but there's also domestic debt. most domestic debt will, of course, be denominated in the local currency and governed by local law.
Sure.
But you have seen a number of countries issuing foreign currency denominated bonds, but in the local market, purchased by local financial institutions. This raises several issues. The first is what the Europeans call the doom loop. What happens in a country where the domestic financial institutions have bulked up on the sovereign's bonds, in a world in which the sovereign has got to restructure those bonds, let's say restructure them in some savage way, haircuts, coupon adjustments, and those bonds are very heavily owned by local financial institutions, your debt restructuring will decapitate your domestic banking system. No country can live without a domestic banking system, forcing you to take all the money that you saved in debt service and have to spend it to recapitalize your banking system. This is a problem that hangs over countries like Italy, where the domestic banking system is very heavily exposed to Italian government bonds, and would, in a scenario in which Italy had to restructure its debt, limit, I think, the tools that a debt restructurer could use, because you simply could not decapitate your domestic banking system. The second complication is this intercreditor equity issue. If I'm a foreign bondholder of Ruritania, and Ruritania has issued foreign currency denominated bonds domestically, I am going to say, now, wait a minute, I don't want to be asked to give more debt relief than those guys are going to be asked to give. Ruritania will sputter in response, but there are local banks. And the foreign creditor will say, you should have thought of that, son, before you stuffed them full of this paper. The other way, of course, that a country can deal with that problem is to say, no, the debt restructuring terms will be universally applied, but we recognize that we may need to recapitalize some banks, or, as Cyprus did in 2013, have a complete overhaul of the local banking system. Some banks going out of business, others having to suffer a degree of loss, their equity holders, and so forth. So there are other ways of dealing with the problem. But as a legal matter, the fact that those FX denominated but locally issued bonds are governed by local law gives the government probably more leverage over them, because they are governed by local law. And if the local legislature passes a law, as the Greek parliament did in 2012, affecting local law governed instruments, it is likely that that will be upheld in foreign courts. There may be issues, constitutional and otherwise, with it, but Greece did it, Barbados did it, in order to facilitate their debt restructurings. But that is a complicated factor. My guess is the decision would be to say all of those bonds get the same treatment, but if that so impairs the balance sheet of an individual financial institution in the debtor country, that there'll be some measure to recapitalize it. As there was in Greece, a portion of what Greece borrowed from the IMF and the EU was hived off to recapitalize Greek banks, and Greek banks held about 30% of the overall debt stock. and they had to suffer the same deal that everyone else did.
That would essentially mean that shareholders of these banks would see a write down in their value because the government would take a stake in the bank. Is that how it works? Is that how it worked in Greece?
Yes, I think it did, actually. There was a government agency set up, but it was 10 years ago, and I'm not
sure.
all that certain. But yes, that discussion will happen.
Should given that its banks could go into crisis, should Ruritania first pass legislation locally that would shield its local banks in some way from being restructured, the locally issued foreign currency debt being restructured before it approaches the Paris Club and the commercial creditors? Will they be caught out if they do that? What's the sequence ideally you think that Ruritania can potentially use?
I probably would not advise them to do that. That would be seen as inflammatory by the foreign creditors. I think I'd rather deal with the situation through some recapitalization mechanism if that turned out to be essential. Argentina did something like this when it approached its debt restructuring in the early part of this century. It passed legislation designed to protect its domestic institutions, its pension funds and so forth, that held Argentine government bonds. But it was an irritant, and I would have to be persuaded that that was a sensible thing to do.
Question here from the audience. How long does a restructuring process typically take? What impact will this have on private market access, i.e. trade finance for private actors?
Yeah. How long? How long is a piece of string? It can take as little as 11 months from beginning to end. It can take much longer, depending on whether the process gets bogged down at one stage or another. Typically, the debtor country will want it to be done as quickly as possible. Look, sovereign debt restructurings are unpleasant experiences. If you're a local politician and are forced into one, and history, by the way, says that local politicians respond with pathological procrastination in these situations. Politicians would much prefer that the disagreeable task of restructuring the country's debt falls on the next administration, not on theirs. But if you're forced into it, typically you want it to be done as quickly as possible, so that the memory of the pain of the debt restructuring and its associated fiscal adjustment is as distant from the next election as it can be in a temporal sense. Will it affect the private sector? Yes, certainly. Normally, the markets will see a sovereign ceiling in terms of the credit rating of private sector borrowers in the debtor country, that whatever the credit rating is of the sovereign, that gets reflected in the credit rating of private sector companies, unless they have a steady, reliable stream of foreign currency earnings offshore that they could use to service their external obligation. And even then, you see, the sovereign power is such that a species of capital controls could require local enterprises that have foreign currency earnings to repatriate those earnings and sell them up to the central bank, that type of capital control was used in Iceland, for example, after the financial crisis in 2008. So for so long as the sovereign is trapped in a debt restructuring, it is likely to make it more difficult, maybe impossible, for private sector enterprises to be tapping the international markets. And therefore, they too will wish the process to be completed as quickly as possible.
So if Ruritanian banks, let's assume, had borrowings from the global capital markets, and the country got into debt restructuring, they would not be able to repay that borrowing with fresh borrowing until a restructuring deal has been completed by Ruritania.
Yeah, I think I'd use the word may not be able to do so. This has been a problem in a number of countries where the domestic financial institutions had their own lines of credit and were not able to renew those lines of credit from the foreign lenders. And a variety of techniques were used in the 1980s and 90s to try to assist the local banks in that process. The difficulty ultimately comes down to the fact that there will be a finite amount of foreign currency in the debtor country. The question is, how do you allocate it? Typically, the central bank will make that decision. And if creditors of the public sector, the sovereign and state-owned enterprises, are being forced to defer or reduce their call upon that pool of foreign currency reserves, those creditors may well say, now, wait a minute, we don't want to see that pool drained out to allow private sector borrowers in the debtor country to service their liabilities in full and on time. And therefore, there may be pressure on the country, in effect, to use its sovereign power in the form of capital controls to induce private sector lenders, both corporate and financial, to restructure their FX liabilities as well.
Let's assume for a minute that Ruritania is hell-bent on not restructuring, at least right now, although its position may appear tenuous to everybody looking at it. Is it advisable, and can it be done, that the Central Bank of Ruritania go and buy back the bonds because they're trading at a discount?
Yes, typically sovereign bonds will contain a provision that says that the sovereign, and in this case, the central bank is not the sovereign, but acting for the sovereign, can repurchase those bonds in the secondary market at whatever price it is. Sometimes there'll be a limitation, and it will say you can only do that if you're not in default on the bonds. The moment you default, your ability to buy them back goes away. But yes, the issue, my friend, will be money. Where are you going to get the money to do that other than the reserves? And so you'll begin to run down your reserves to the point that the perception of the market is that the crisis is now unavoidable. So yes, it is possible, but very often there's a practical constraint in doing that in any size.
Again, a question. In terms of foreign trade and imports, are private sector actors likely to be affected? I would assume this is during a restructuring process.
Yeah, very often when the IMF comes into a situation like this, the IMF will want to achieve two things quickly. First, stimulate exports, and you do that by devaluing the local currency, and reduce imports. You do that by devaluing the local currency. And so it will have an effect, and typically an immediate effect on trade. What rendered the Greek problem particularly difficult in 2010 was that, of course, Greece belongs to the monetary union. So the euro is the currency in Greece. Greece itself had no ability to devalue the euro. And therefore, that traditional technique of a currency devaluation as a means of stimulating exports and reducing imports could not be used. And the result was the economists had their own euphemism. They called it an internal devaluation. What they meant by that was you're going to have to cut pensions, the public payroll, raise taxes, and do all of these other things in order to restore competitiveness in your trade position.
There's a question here. It addresses or talks about the pari passu clause. I'll put the question to you, but I think we may have to define what this pari passu clause is. Would a discounted cash tender offer only targeting a particular maturing bond breach the pari passu clause when after that it is known that a country will not be able to continue to pay? There is a concept of preference clawbacks in the context of ISBs, like in domestic insolvency. What is a pari passu clause in the first place?
Okay. Pari passu clause. Pari passu is Latin for in equal step. It is a one-line clause in a cross-border debt instrument which says, this instrument ranks, important word, ranks and will rank pari passu equally with the issuer's other debt instruments. The clause entered cross-border documentation in the late 70s when commercial banks realized that there were some countries, not a lot, but a few, that had laws that permitted a debtor to go to a particular notary, pay a fee, and get a debt instrument stamped. And the result of that was that as a matter of law, that instrument ranked senior to any other debt instruments that the issuer had. Now, that's something not possible under US or English law. It's an involuntary subordination of an existing creditor, but it is possible in some countries. So the pari passu clause was meant to prevent that from happening. In effect, involuntarily subordinating someone. In the middle of the Argentine crisis, however, the holdout creditors in Argentina persuaded a New York judge that the promise to maintain equal ranking of debt connoted, surely didn't say, but connoted a promise to pay equally ranking debt ratably. So if you and I are both creditors of Ruritania and Ruritania wants to pay you, the argument was they also have to pay me ratably. That was a fallacy. It was never meant to that. But for a while, this New York judge embraced the fallacy in order to get Argentina to the settlement table. As soon as they got to the settlement table, he reversed it. And I think under New York law now, certainly under English law, a promise to maintain equal ranking is not a promise to pay equally ranking debts on a ratable basis. So in your example, could, and I'm assuming now we're not in default, could Ruritania do a discounted cash buyback offer for one bond but not another? Answer, yes. That would not violate the pari passu clause.
Another question. In a country where roughly half the Eurobond stock has CAC, collective action clause, aggregation clauses, would you expect such bonds to get favorable treatment, similar to Ecuador?
Let me just give the background for the
Sure.
benefit of folks. I said earlier that collective action clauses were promoted in emerging market sovereign bonds starting in 2002 after the Argentine default. Those versions of collective action clauses operated in each series of bonds, so within the four corners of a series. And that turned out to be a weakness, because if you have a small bond, a holdout creditor who acquires 25% of it can block use of the collective action clause. In 2015, there was an effort to broaden that and have aggregated collective action clauses that would operate across an entire universe of a sovereign's bonds. All holders of all bonds would vote collectively in an aggregated way on a restructuring program. And the theory was much harder to buy 25% of an entire debt stock than it is to buy 25% of a single bond. Aggregated collective action clauses post 2015 are gradually coming into use. Many countries now have some bonds with the old style and some bonds with the new. Your question is, would the debtor give preference to the new aggregated clause? It's actually probably the other way around. Would the creditor, because the old version of the clauses are more restrictive, would it throw a few extra bucks at the holders of those bonds to get them to come along? I would probably advise against it. Again, go back to creditor psychology. They will be focused on intercreditor equity. And the moment you start to say, because of some provision in your bond, we're going to give you a financially sweeter deal than your fellow creditor over here, you will alienate the affections of that other creditor, making it more difficult for you to get them in the deal. I would probably not advise it, but again, each case is each case.
So we've got an audience that is both global. Some of them seem to know the subject quite deeply. Others are very curious. And among those who are curious are those who want to know about how you deal with holdouts. What are holdouts? In current sets of negotiations around credit restructuring, how common are holdouts, and how do you deal with them?
Yeah, this is a perennial issue in this business. Starting in 1976 in this country, 2 years later in England, creditors of sovereigns for the first time were able to sue those sovereigns in US and English courts. And so a debt instrument issued in the last 45 years by a sovereign means that the holder of that instrument is theoretically entitled to decline any debt restructuring offer, and if it is not paid in full and on time, to go and sue on it and to try to extract a preferential recovery at the sharp end of a lawsuit. That's the reality. It wasn't a problem much in the 80s and early 90s because the commercial banks were the universe of creditors, and commercial banks either responded to peer pressure So other bankers would say to them, well, you're breaking ranks with us. And when that failed, they got a phone call from their regulators that said, we expect you to go along with Ruritania's debt restructuring. But when the banks left in the late 90s and were replaced by bondholders, you're talking about thousands of individual bondholders, every one of which is holding a piece of paper that is legal, valid, binding, and enforceable in a New York or English court. And how do you herd those cats into a debt restructuring, recognizing that by definition, the debt restructuring is about to impose a loss on them? It was in response to that the move toward collective action clauses came about. There was, and still is, a competing theory promulgated in 2002 and 3 by the IMF for a while, that what we need is a transnational sovereign bankruptcy code. We don't have this problem in corporate debt workouts. Why? Because insolvency codes say that if a supermajority of similarly situated creditors agree to the restructuring, it binds everyone. And so there was an effort to develop what the IMF called a sovereign debt restructuring mechanism, but it didn't prosper for political reasons. The alternative was the use of collective action clauses, but as I mentioned a moment ago, they have their limitations too. It is possible for determined holdout creditors to stymie the use of a collective action clause. How do you deal with holdout creditors? I'm going to be candid about it. It ultimately comes down to the sovereign saying to the prospective holdout creditor, look, if you want to, you can get a judgment. We probably can't stop you. But think carefully, because that judgment will convey to you an emotional satisfaction. It will not convey a financial satisfaction unless and until you can find some asset of the Republic of Ruritania outside of Ruritania that you can seize and pay yourself back. And now listen to me. There are very few such assets in the name of the Republic of Ruritania. And what assets we do have, our embassies, consulates, and so forth, are clothed with immunity by your law, by US law, by English law, by international law. So think carefully. You can get your judgment, but then we'll search the world trying to find an asset that you can seize to pay yourself back, and you won't find it. So think carefully before you decide to spend all of your money on legal fees. This could end in 10 years with you having nothing but your regrets and your legal bills. That is the sovereign's ultimate argument. Louis XIV used to emboss on his cannon a Latin phrase which translated as the king's last argument. This is a sovereign's last argument.
We've heard, the legend has it that, there are distress credit buyers who do so in the hope of, getting a big payoff. Are these still common, or are the players very much the big hedge funds, which are fairly serious about investments?
Most of the creditors understand the reality that if you lend money, you take a risk, and occasionally the risk materializes. Most institutional investors will expect the sovereign to behave maturely and responsibly, not to try to use a debt crisis as a tool for stirring up domestic political popularity. And a sovereign that behaves in that way can expect support from the vast majority of its commercial creditors. There will be some, however, who will approach the process with malice aforethought, who will say, I don't care what the restructuring terms are, I am going to try to pressure the sovereign into a preferential recovery for me. And they will probably have the legal tools to do it, although collective action clauses can be extraordinarily useful in defanging creditors that have that view. Do they still exist? You bet they still exist. And indeed, the long, tortuous Argentine saga, which lasted 15 years between default and final settlement, the holdout creditors who were still standing at the end of that 15 years got a very generous payout, very generous. And there is a concern in the sovereign debt community that the memory of what happened in Argentina may induce holdout creditor behavior in future sovereign debt workouts. We don't have a perfect solution to this problem. And remember, I said earlier, it is a zero-sum game. If a creditor succeeds in extracting a preferential recovery from the sovereign, they're not just injuring the sovereign, they are affecting all of their fellow creditors, because they're depleting the pool of resources that will be used to pay those other creditors. So this is an intercreditor equity issue as well. Emotions run very high on this subject.
This next question can complicate the intercreditor equity issue, maybe what size the pool is in the first place. And that is, what happens in the process of a restructuring when previously undisclosed debts from the government surface, making the overall debt claim larger? Do those debts that were not declared by the government previously have equal legal claim?
A difficult question, but I'm afraid we've seen examples of this recently. As a legal matter, those undisclosed debts remain debts of the government. The fact that they were undisclosed often, however, suggests there was an element of corruption or impropriety in their incurrence, and that may give the debtor government a basis on which to challenge the enforceability of those claims. That is going on right now in English courts with an African country. But it complicates things immensely. It has always been my view that you never lie to your physician, to your lawyer, or to your IMF mission chief, and also your bartender. Those are the four individuals on the planet you should not lie to. If you lie to the IMF about the state of your public sector debt stock, and they discover it after they've been trying to help you, it embarrasses them and will have ramifications. It also, of course, erodes the confidence of your other creditors, bilateral and commercial, in the management of your debt stock. And that too will have ramifications. It happens, but it complicates this process and drags it out sometimes for years.
Lee, when I spoke to you, I suggested this conversation will go on for 2 hours. We are approaching 2 hours. We're just 5 minutes away from 2 hours. We have 200 people on the webinar and many more people. I'm looking to see if I can get a number online. I'm just wondering how you're on for time, whether we can just... Oh.
I'm fine. The sun has come up. Morning in Ruritania.
Yeah. It's 6:30 p.m. here, so let's see how many other questions we can get in here. this is hypothetical. This is if Mauritania has $4.5 billion in maturing credit in 2020, including $500 million bond maturing in January 2022. Sorry, if Mauritania has $4.5 billion maturing in 2022, including a $500 million bond in January 2022, and a $1 billion bond maturing in July. So that's $1.5 billion with reserves of $3.5 billion. At what point should it start speaking to creditors?
Well, I think I would certainly start speaking to the IMF. I said earlier that the politicians typically react with pathological procrastination in the face of these problems. They will sincerely wish it to go away. The IMF even has a term for it. They call it a gamble for redemption. The hope is that between now and the date that the bond matures, oil will be discovered under the presidential palace and everything will be okay. It is dangerous and harmful to decide to run one's reserves down in order to pay maturing indebtedness that cannot be refinanced from the market. Again, we are in an unusual circumstance in which, as a result of quantitative easing, institutional investors are literally stuffed with money that they have to deploy. And that has had the effect for many institutions of reducing, some might say, anesthetizing their normal risk instincts. And therefore, countries, sovereigns across the globe in the last 10 years have been able to borrow in circumstances and at interest rates that any sober historian of this process would say are wildly incommensurate with the underlying risk. But nonetheless, they've been able to do it. And I suspect there will be close study of whether it is possible to refinance maturing debt. The coupon may be higher than one would like, but, you know, again, politicians in these circumstances evidence a profound belief in the efficacy of prayer. The danger is that you find yourself in a debt spiral, that you refinance at an interest rate that is insupportable. And the market perceives it, and the market then wants higher interest rates for any subsequent borrowing, and at some point they'll shut off entirely. Greece, in the fall and spring of 2009-10, was in exactly that position. North of 300 billion euros of maturing bonds and no ability to refinance them in the market. If you can, you can try to jolly your official sector supporters into lending you the money to continue that, but that is if you don't have an enormous amount of geopolitical influence, that is probably not going to happen.
Here's a related question. Why do countries procrastinate about debt restructuring? Is it misplaced sense of vanity? Is it cultural? You know, you've been dealing with sovereigns of all hues. What have you learned?
It is partly cultural. There are countries and areas of the world that regard a sovereign debt crisis as dishonorable. I have a vivid recollection of 1997 in South Korea. They had put up buckets on street corners, and people would come by and take off their gold wedding rings and throw them into the bucket. in order to try to help the government avoid the dishonor of a debt restructuring. There are other parts of the world where restructuring the money lent by gringos is nearly as popular as soccer. And there is no particular shame attached to the exercise. You ask, why do politicians delay? Look, most politicians know that the politicians who lead a country into a sovereign debt restructuring are rarely the ones who take them out of it. It is an inherently disagreeable process. It will almost assuredly involve fiscal adjustment measures that are politically unpopular. No politician wants to do that. I remember I was called once to see a finance minister. We had a chat, and they had not defaulted. And in the old days, accepted wisdom was you had to default to show your creditors the seriousness of the situation. Modern theory is exactly the opposite. Modern theory recommends what's called preemptive debt restructurings. Restructure before you default, because once you default, things get a lot more complicated. Lawsuits begin. So I had this conversation with this minister, and I ended it. I said, "Sir, let me commend you that you are dealing with this problem in advance of it becoming a howling crisis, forcing you to default." He said, "Son," he said, "don't you think if I could hand this bag of garbage was not the word he used, to the next administration, I would do it?" He said, "but unfortunately, we don't have an election for another 8 months, and we don't have the money to last 8 months." And I said, "I understand, Minister." Look, there's something in the DNA of the political flesh that wants these disagreeable things to happen to your successor, not to you.
During a restructuring process, does the sovereign usually continue to service the debt, service interest? How does it work?
Sometimes these are the so-called preemptive debt restructurings, where the sovereign does not default. Greece never defaulted. They came within 8 days of it, but they never defaulted. Uruguay, 2003, never defaulted. If it can be done, yes, that's probably desirable. The two things cutting against it are, first, this impression that creditors won't take seriously the situation and won't be prepared to entertain requests for deep debt relief for a country that is continuing to service its debt. And second, the time pressure in that scenario is wholly on the sovereign debtor, not on the creditors. You see, if you stopped paying and the creditors are missing coupons, the secondary market value of their bonds is declining. Every morning when they turn on their computers, they, to use Bill Clinton's phrase, feel your pain, because the secondary market price has dropped. That said, if it can be done, probably, all other things being equal, better to do it before a default. The default tends to build up accrued but unpaid interest. Creditors in a debt restructuring will always ask for that components to be paid in cash. So it's, if it can be done, probably better to do it before there's an outright default. And I think the longer term memory of the debt crisis is less indelibly stained if there hasn't been an actual default.
You mentioned in the early part of this conversation that it typically takes at least 11 months for a debt workout. Mm-hmm. And if a country was so essentially a country has to plan at least a year in advance its cash flow if it doesn't want to end up in the situation that we just discussed, which is not being able to service its coupons or in fact make lump payments.
Yeah, I mean you can sketch it out. Presumably the first call is to the IMF. That'll produce an IMF mission a week or two later. They'll take some time to do their study. They will recommend a program. They'll do a debt sustainability analysis. Really only then can the country begin to ask for a meeting with Paris Club creditors and commence the commercial debt negotiation. Depending on what it is asking for in debt relief and how unpopular that is with the creditors, those negotiations can go reasonably quickly or can drag out for many months. Even once a deal is struck, we live in a world where the commercial debts are typically represented by securities, bonds. There will be a process for issuing new bonds that has to be done, and that takes time. So, yeah, a year in advance of an anticipated closing is probably about right, even if things move quickly. And they cannot move quickly. Argentina defaulted in December of 2001, did not get around to restructuring those debts until the middle of 2005. So it can get bogged down.
Sure. That's an interesting thing you happen to mention there. A restructuring means also that creditors get new bonds, do they? That specify new terms.
Typically in a commercial restructuring, yes, it's called an exchange offer. You typically do not try to amend your bond within its four corners. You would issue a new instrument to replace it. Now, what Belize is doing right now is very unusual. It's doing a cash buyback of its bond for 51.7 cents on the dollar, but that is being funded by a nature conservancy organization who's prepared to lend Belize that money. But that's very rare. Garden variety transaction would be a bond exchange.
Tell us about this, because Sri Lanka's got these natural assets too. I don't know if they're comparable to what Belize, for instance, has, but what is a green bond?
Well, a green bond, or in Belize's case, a blue bond, is a security whose proceeds, the proceeds of its issuance or a portion of the proceeds, would be used for nature, environmental conservancy purposes. In Belize's case, as an inducement to get Belize's bondholders to accept a transaction in which there's a deeply discounted repurchase of those bonds, Belize is prepared to covenant that it will pre-fund a so-called endowment account that would be used in perpetuity to fund marine conservation projects in Belize. Belize has the second largest barrier reef in the world, and it is extraordinarily important in terms of biodiversity and so forth. So, but that's an unusual situation. But
is that a significant amount they're discussing with Belize?
For Belize, yes. It is Belize's only international bond. It's about 560 million US, which for Belize is significant. So But I would expect, in a world in which the official sector is obsessed with climate issues, I would expect to see in future sovereign debt restructurings features that attempt or that induce the debtor countries to finance environmental projects in their own countries effectively with their creditors' money. I would expect to see that.
Okay, let's take a few last questions. This has been a very long conversation. Do IMF programs related to restructuring differ from the usual IMF program? If so, how?
Well, again, the IMF programs will come in one of three types. If the assessment of the IMF is that the debt is unsustainable, then they will ask for a debt restructuring as part of the program. If the debt is viewed as sustainable, but in effect a liquidity crisis, there may well not be a request for a debt restructuring. There'll be other fiscal adjustment measures. And if it falls in between, where the staff can neither with confidence say it's sustainable or unsustainable, then the outcome may well be a reprofiling. Again, don't be misled by the word reprofiling. Reprofiling is a species of debt restructuring, just the mildest one, with no coupon adjustment and no principal haircut. So, yeah, but look, if the debt is deemed unsustainable, I imagine the fiscal adjustment program will be harsher than it would be if the assessment were that it's a simple liquidity problem.
A few final questions, Lee, and that is, when bond holders approach a discussion, do they have a yield in mind that they'd like to achieve? From a very practical point of view, so then it's a matter of figuring out which components to adjust by which degree to achieve that final yield. Is that how it works?
Yes, to a degree. The bondholders will assess the situation, and they will form a kind of collective judgment about what they will call the recovery value. So I hold a piece of paper that says I'm owed $100. The country is in debt distress. That piece of paper is trading in the secondary market for, let's say, $40. The bondholder will go into the debt restructuring and say, I'm prepared to provide debt relief. And hopefully, the market will perceive that debt relief, when taken together with the fiscal adjustment that the country is undertaking, often at the insistence of the IMF, and any official sector support that the country is getting, that those elements will improve the country's credit position such that the piece of paper that I get in return for my $100 bond, while it might call for a payment of $70, will nonetheless be valued in the market higher than the $40 that I'm currently holding. And that valuation of the new piece of paper is called the recovery value. It is highly dependent on what the market calls the exit yield, exiting the debt restructuring, the yield meaning what is the discount rate that the market will apply in valuing that. And again, the hope is that a confluence of those three factors will reduce the discount rate over what it is today in the middle of the debt crisis. And will they have a view? Yes, they'll collectively have a view. I don't want to suggest that the bondholder community is a Borg collective, but it is, they will reach a consensus more or less on what that recovery value is. And then the negotiation comes down to whether that recovery value expectation is consistent with what the country feels it needs by way of debt relief. And that's the negotiation.
Here's something about the banks, about state-owned banks. Would the foreign exchange loans of government-owned banks be also subject to restructuring in the case the sovereign opts for restructuring of its own debt?
Yes, very, very often, yes, the debt restructuring will cover not just the republic, but public sector instrumentalities, the public sector. And that can sometimes, not always, cover public sector banks. The theory, again, being there's a finite pool of foreign currency resources in the country. If you allocate them to allow other debtors in the country to repay their debt in full and on time, you're depleting that, meaning that the creditors of the republic itself are injured. And therefore, typically one would expect to see the debt restructuring covering not just the sovereign, but its public sector as well. Sometimes even its private sector.
Assume for a minute that Mauritania had electricity utility owned entirely by the government, which has on its balance sheet borrowings from official sector sources, particularly bilateral sources. Would that be subject to restructuring?
Could be. Again, if that entity has foreign currency earnings that it could use to service its borrowings, it might be allowed to continue to do so. The one, from a legal standpoint, good news about this process is that US and English law will regard state-owned instrumentalities, even if 100% owned by the government, as having a separate legal personality from the government. And so normally, a creditor of the republic, for example, would not be able to seize an airplane of the national airline as long as the national airline is separately incorporated and is run with a degree of independence. So that, but in the example you cite, it may or may not be brought into the restructuring.
Lee, this has been an insightful, long, but very engaging, fascinating conversation. I think we have still close to 200 people online, but it's been 2 hours and 17 minutes since we started talking. I think we've covered a lot of ground. Is this the typical sort of conversation you have when you enter a market or when you talk to a sovereign for the first time? Are we not discussing anything that a sovereign would ask you in the first instance here?
No, the list of questions are pretty much the ones that you have put. Who do I restructure? How long will it take? What can I expect on the other side? So it's we've sort of done that in the last 2 hours and 17 minutes.
Typically, how much can a sovereign expect this to cost? I'm sure. I mean, let's assume it's a sovereign with creditors totaling, say, $35 billion. How do you sort of price for services that you would require?
Yeah, it's expensive. I don't think I can give an estimate. If it's wrapped up in a year, it'll be in the millions of dollars of expenses that will be incurred. Typically, a creditor committee would ask the sovereign to reimburse its legal and financial advisor expenses. So the sovereign will be paying for its own lawyers, its own financial advisor. It will be asked at least to reimburse its creditors' expenses as well. So it's expensive, and as I say, it is an inherently disagreeable process. Remember what you're doing. You're going to perfectly sensible people and asking them to do something that no perfectly sensible person would ever do, which is to reduce or stretch out their claim against the country. So it's inherently difficult task.
Are these priced in terms of the quantum of debt being restructured, or it's simply negotiated?
No, well, sometimes, the lawyers ought to be doing it on a conventional hourly rate. Sometimes the financial advisors get it into their heads that they should be getting a percentage of the treated debt, of the restructured debt. That's how investment banks often try to charge for their services. But that's a matter to be negotiated.
Have you experienced conversations across the table that have become heated, violent?
Yes. Well, not violent, I'm happy to say, but heated. Look, put yourself in the position of the Minister of Finance. You're being asked to impose on your citizens painful fiscal adjustment. To sit across the table from a group of creditors or their advisors who see this as an opportunity to make a great deal of money. As one of my clients once said, it is like trying to pry the gold teeth out of the corpse. It can be an emotional conversation. No one says that people shouldn't be paid. It's a question of whether it is an opportunity to be paid more money, perhaps, than the work would reasonably entail.
Have you are negotiations done by proxy for as far as the sovereign is concerned? Do they have their bankers, lawyers sit at the table? Have you found instances where central bank governors, finance ministers speak to creditors?
Yes, certainly. And again, this will depend on the country. The creditors will at some point want to see the government authorities. They won't listen to a group of hired advisors. But you see, in these face-to-face negotiations, there is a sensitivity. You're talking about a sovereign. For a hedge fund manager to sit on the other side of the table and wag his or her finger at the Republic of Ruritania is unseemly. And so it very often happens that the hedge fund manager can wag their finger and look at the advisor, the lawyer, the financial advisor to the minister who's sitting right next to them and say, you should be raising taxes. But he's not saying it to the minister. And that little bit of camouflage can sometimes ensure that there aren't any lasting damage to the relationship. Remember, many of these institutional investors hope that they'll be doing business in the country next year when things are getting better. The last thing they want is to unintentionally bruise the authorities so that they are no longer persona grata in the debtor country. And one way of doing that is to direct harsh comments to the advisors as though they were intended for the ears of the advisors.
Have hedge funds, in your opinion, ganged up against countries that try to force or manage to force a bad deal on them by not subscribing to their debt in the future?
Yeah, they will. Well, that used to be the belief that if you inflicted disproportionate bruises on your existing group of creditors, that your future creditors would remember that and punish you for it. That is largely a myth. Look, if you and I were negotiating the debt of Ruritania right now, and I'm the debtor, and I say to you, I want a lot of debt relief. Next year's investor, the guy who's going to buy my bond next year, if he were listening into this conversation, would say to me, Lee, bring the sword of the Lord to your existing creditors, because every dollar of debt relief you can extract from them today makes you a better credit risk tomorrow when I'll be investing in you. But in the old days, they used to portray it as, no, we're all one great collective, and if you injure any of us, all of the rest of us will punish you for it. But that's it. What the market will remember is how the country conducts itself. Maturity, moderation. These are things the market will remember long after they've forgotten the level of debt relief that the country actually asked or received.
Lee, again, what a wonderful discussion it has been. We've got lots of people who participated, thanking you for the breadth and depth of this conversation. This may be second nature to you, but for all of us listening here, this is the first we're hearing of this, and it looks like we've got a lot of work to do in front of us. If Ruritania indeed decides to take the path that looks like the one it should be taking. A quick note to everybody out there: we've shared a primer on Sri Lanka's debt sustainability by Advocata. It's a public document. I've shared it with all of you on this call. You can download it. You may have already done so. It's been up for a while now. I'm sorry I couldn't mention this before. And thank you for all the great questions from everybody who participated. We've only dropped below 200 just a little while ago. And we had a diverse audience, I can tell you, from official lenders to consultants around restructuring to bureaucrats and lots of commercial bank heads, directors of commercial banks. Thank you very much, all of you. I think we're talking to the right people. Lee, what you did here was immeasurable. And I think this will be very useful for Sri Lanka or Ruritania to re-examine its ability to sustainably service its debt. And if we get that conversation going, I think we have done a lot for the citizens of Ruritania. And I thank you so generously for being so willing with your time. This is sincere, and thank you very much.
Well, my pleasure, my friend. I enjoyed it very much, and viva Ruritania.
Viva Ruritania, indeed. Thank you very much, Lee.
Thank you so much. Bye-bye.
Bye-bye.